Good morning. It is a great pleasure to welcome everybody to this third day of the annual New Hampshire Summit on systemic inclusion. We are getting the day started in wonderful fashion. New Hampshire Banking Commissioner Gerald Little is very kindly joining us to introduce Jason Keller from the Chicago Federal Reserve. We're going to have a very exciting conversation this morning around what federal policy and practice can tell us around bank support under the Community Reinvestment Act for economic inclusion can allow us to do to address poverty, which is, of course, an incredibly timely conversation today with the pandemic. And want to add, on behalf of the National Collaborative for Digital Equity, we're really very, very grateful to all of our partners and our amazing presenters. And I just want to add a brief prefacing remark that there is a consortium, Jason and Commissioner, there's a consortium of 12 bank presidents in Manchester, New Hampshire, that have come together to look at systemic inclusion, financial, economic, educational, and digital, to lift LMI kids K through 12 out of poverty. One of the key priorities they've identified as low-hanging fruit that they want to address early on is strengthening inclusive pathways into living wage jobs, starting with banking itself. So this is a wonderful teachable moment for these banking leaders. And we've shared a little bit by way of preface, Jason. We've shared a little bit about your wonderful insights around this topic. And there's tremendous interest, and this is very timely. And more broadly, with Will Arvello and others, I believe are on the call now as well. And Will is Director of Economic Development for the state. One of the concerns that he's raised is around the notion of benefits cliff, which is, of course, one of the barriers that those who are in poverty face when they're trying to go from being underemployed or unemployed and getting into employment. Sometimes they can't afford those intermediate stages where they make too much to be eligible for subsidized childcare and healthcare and other benefits. And therefore they can't sustainably support their families to get to that next stage. So the insights that Commissioner, that you and Jason are sharing are literally life-changing. And we just want to thank you profusely. With that, Commissioner, it's a great honor for you to join us again. And if you would kindly do the honor, sir, and take us away.
Certainly. Thank you very much, Bob. And I really appreciate being asked to do this very simple thing. I do want to point out that the FDIC since 2009 has been surveying and tracking the percentage of Americans who are unbanked. And on Monday of this week, a very fresh report came out that shows that in 2019, 95% of Americans had a transactional account with either a bank or a credit union, which is great news. It's the highest number they've ever recorded. But then, of course, COVID hit in 2020. And so, as the report points out, it's things like living in poverty, having a job, and other challenges that determine whether or not somebody is banked or unbanked. And we all know that COVID-19 has had, unfortunately, negative pressure on those things that determine whether or not someone is able to have a bank or a credit union account. So very, very timely information. 95% is a lot. 5% is going to be, the last 5% is going to be the hard part in my mind. And to sort of combine banking and the digital equity argument, this reminds me of trying to accomplish the last mile of connectivity to the internet. That's the really tough part, is getting wires out to rural America, to folks who really need to be able to access it for teleworking, for distance learning, for schools, for telemedicine, and those sorts of things. So as you mentioned, Bob, the low-hanging fruit is probably gone as far as increasing access of the unbanked. This is where the hard work has to be done, and I really appreciate everybody that is involved in this effort. Jason L. Keller is a Community and Economic Development Senior Advisor in the Community Development and Public Studies Division at the Federal Reserve Bank of Chicago. Mr. Keller has a sociology degree from Illinois State University and a master's degree in public policy and administration from Northwestern. Since 2011, he's overseen and evaluated economic capacities and sustainable growth opportunities within the Federal Reserve's 7th District by conducting seminars, workshops, and preparing other written and digital materials dealing with the Equal Credit Opportunity Act and the Community Reinvestment Act and other consumer protection laws and regulations. Prior to this role, Mr. Keller spent 13 years as an examiner in charge in a managing role, assessing compliance with various regulations in community, regional, and large state member banks and bank holding companies throughout the Fed's 7th District. He's an active member of several economic and civically minded organizations throughout the city of Chicago. He speaks, trains, and moderates sessions on various topics related to CRA and fair lending to bankers, government officials, nonprofit leaders, students, and others, all to increase knowledge on furthering fair access to credit, capital, and opportunity. And it's a real pleasure to introduce Mr. Keller to you this morning.
Great. Thank you very much, Jerry. I appreciate that kind introduction, and thank you very much to Bob and team for bringing me aboard for this very important conversation. I have been listening to other sessions, and I will tell you that speaking throughout the country on this topic and related to others, I often don't hear CRA as much as part of the conversation as I have during the past couple of days. So I commend those for working through this admittedly complicated regulation. I think about CRA a bit like poker, where it's a minute to learn and a lifetime to master. I've been working through CRA and its related challenges for the past 20 plus years, all at the Federal Reserve Bank. And what I'm going to talk to you about today is investing in America's workforce. But I'm going to walk through different pieces of what the effort has been since 2017, and then catch you up to what we've been doing recently on COVID. But I want to start, if you can move to the next slide. The way that we've titled this is CRA Learn, Earn, and Economic Inclusion. And I think that the title is very appropriate based on what I've heard the past few days. So thank you again to Bob for bringing me aboard. If we move to the next slide, we're going to look at our agenda for this morning. And I want to walk through an introduction. I want to define workforce development. I'm going to talk about the program. I'm going to tell you what we've learned through hundreds of interviews over the past few years. I'm going to highlight some books that the Federal Reserve released. I'm going to talk specifically about workforce development related to CRA. I'm going to highlight some strategies that we think are investable. I've got a couple of slides along the racial equity and talking about some promising strategies going forward. And then I've got an appendix there at the end. So let's move forward. So again, the standard disclaimer, similar to my FDIC colleague, the views expressed today are really those of my own. This is not legal advice. This is not guaranteeing CRA credit. But any of you who have heard me speak nationally before, I'm very candid, I'm very honest. I'm very here to give you some takeaways that you can use within your body of work. Although I do work in the Federal Reserve 7th District, which includes portions of Illinois, Wisconsin, Indiana, Michigan, and all of Iowa, I do speak nationally on this topic, and a lot of what you're going to hear is information that we've gathered at a national level. So next slide, please. So again, CDPS, Community Development Policy Studies, Jerry provided the intro and the states that we supervise. But our goal is really to improve the lives of low and moderate income communities, both individuals as well as the businesses and farms that work there. Our responsibilities, what we really see, are research, convene, and connect. We have PhD level research happening within my function. My role as a convener and a connector is to get out there and talk about what we are seeing through the outreach that we do, and then highlight tools available across the country, which are free of charge for individuals such as yourselves to think about this in your own individual market. So let's move forward. So as we started thinking about workforce development, we realized very quickly that there are different definitions. All of them are good. You can ask a pool of practitioners, you can ask community colleges, you can ask people, employers, how do you define workforce development? So what we did in 2017 was make an attempt to use a standard definition. And I won't read this to you, but I want to highlight two words. The first one is system. Workforce development in our mind is not a series of programs. It's not elements that have a starting place and an ending place. It is a collaborative system that brings together like-minded individuals that really bring a central view or a meeting point between meeting employers' demands and those looking for work. And then the second phase is really what our former chair, Janet Yellen, had said, which is different types of initiatives that help prepare people for jobs by providing them with training, placement assistance, and other support. And it's really all of these that come together under the CRA, the Community Reinvestment Act bucket that I'm going to talk about here further. So we can move forward to the next slide. So what is the Investing in America's Workforce Initiative? So this is a Federal Reserve System collaboration of all 12 reserve banks across the country. We attempted to get out there and do outreach that explore the regional aspects of improving outcomes as well as investments. We had a very large national convening in 2017. We've held a series of listening sessions. We put out a couple of books, which I'll talk about, but I really want to focus on this last bullet where we tried to broaden who we were talking to. We're talking to bankers, examiners, practitioners, government officials, academics, business owners, and others, even individuals, both employed and underemployed, unemployed, around what they're seeing in the workforce system. And that's where we got to as a release of these books. So let's move on to the next slide. So this map is always very telling to me because in 2017 and 2018, we did 50 listening sessions across the country, and we did cover 32 states, and realizing that we could not get to all of them in that short period of time. But in the aggregate, this is over 1,000 individuals that were able to provide some answers to some very key questions. And my goal here over the next 20 or 25 minutes or so is to summarize not only what we heard, but what the response has been to that conversation. So let's go to the next slide. So this is what we heard, and granted, this is all pre-COVID. And a lot of what these bullets are is not going to be a surprise to anyone that's part of this conference. But there is a skills gap, and we're seeing still a mismatch between the demand of workers versus the supply of those jobs available. But I want to stress really that second part, that we're seeing different issues in different markets, and different markets being defined as urban versus rural. And we know that sort of typography is going to yield different challenges. So we really expect responses in those different typologies to be different, and we can talk a little bit about that. But where we're really seeing are these non-skill related barriers. You're talking about addiction, incarceration, criminality, childcare, self-reliable transportation, affordable housing. These are all things that I've heard in some form or fashion over the past few days as a part of this conference. These are all issues that are not unique to any individual market, and we're expecting interventions to vary across the country. But there are some real good examples of even in New Hampshire and other places that you all are in a much better position than me to tell me what's working and related to addressing these non-skill related barriers. But it was amazing to me when you talk to employers just about the percentage of individuals, employees who are struggling to get to work on time and be reliable in their attendance. And that's just something that is probably very much part of these non-skill related barriers that I think the system as a whole needs to address. The next bullet is around technological advancement and the role of automation. And this goes without saying that skills have to change as we move in throughout the 2020s. You're going to see even more technology come into play. But it's really the ability of employers to train incumbents and work with colleges and others to build those right skill sets at the right time. The better employers of what we're seeing are not hiring for today. What they are doing is filling open positions that they believe that they needed 2 or 3 years earlier. Now, granted, this is pre-COVID, but if you're talking about an employer strategy for employment, how are employers looking forward? What are their demands for employees 2 to 3 years out that they can then build those skills either through their own workforce or through hiring from the outside? But I think this goes back to this idea of the benefits cliff and the quality of available jobs that are impeding economic mobility. So at what level are individuals topping out? At what level are those non-skill related barriers preventing individuals from moving throughout the organization? You're going to start to see some variance here, but this was a very consistent message of what we heard throughout our 50 listening sessions. Let's move forward. So a lot of words on this slide. I wanted to get them all in. So I apologize for the small font, but what are we hearing during COVID? And there are hundreds and hundreds of outreach calls that are happening throughout the Federal Reserve System, but I tried to boil them down to really these top 6. And the social distancing requirements, as we've all talked about in this conference, and the need for high quality, accessible to digital learning. But if I could change this bullet, it would also be digital execution. So the idea is that what percentage of workers can do their jobs remotely, but also do them well. You're talking about stresses on digital platforms, yes, but you're also talking about mobilizing a workforce that only a certain percentage was really set up to work remotely, and there have been some challenges. We talk about the digital divide facing students and workers, but also the financial consequences of the inequities in that divide. And I think Jerry had talked about that previously in the FDIC survey, but you're really talking about access to funds very quickly and being able to use technology to transfer money. And I think we heard that a little bit yesterday about how money is moved and the access of employees to get money to friends and family when needed. And that third bullet I think is very good, but as companies think about returning to work, many will not have those resources to pay for the additional training. And that's really where I think financial institutions and workforce boards can step up and work collaboratively on getting the right people in the right jobs at the right time. But this underscores that need for flexibility, the idea of literacy, both financial and digital, basic education requirements, job training and internships. I really like that earning while learning model that I think we've also heard about. But this gets back to the job quality and the wage gap that has also come up. But it's employer of choice. Those employers in any given market that are having strong coverage, strong benefits, flexible schedules, access to PPE, this is where employers are not having to fight for employees. They're already paying more than a fair wage. They're already providing their employees that flexibility to deal with family related or personal issues. But that last bullet is one that I think we've already talked about in some of the schools, but that concern for youth, young adults, that at-risk population that may be left behind. We're seeing examples of funding cuts within cities to youth programming. There's the Federal Reserve in Chicago, at least, is now thinking about summer jobs of 2021 and how to open up more opportunities for at-risk youth or opportunity youth to get them something to look forward to for next summer as they start to recoup from potentially losing or lost income over summer 2020. Next slide, please. So we put out 3 books, and these books are free. You can go out and download individual chapters. You can download every chapter. You can request copies of the full books. But essentially, we broke this up into 3 volumes. And this first one we call Investing in Workers. So not going to read to you every chapter, but there are examples of undervalued human capital. We think about the future of work. This being Disability Month, we think about workers with different abilities, all very timely in how we can invest in workers in their interest in furthering their own careers or positions. Next slide. Volume 2 is investing in the work itself. So this is talking about rural, this is talking about local economic development, this is talking about quote unquote good jobs. And when I do a session like this in person, when we get to this slide, we actually talk at our tables around what the definition of a good job is. And what you're going to see in this chapter is sort of some variance around that. But good, we think we all understand what a good job is, but there's going to be differences depending on age, depending on experience, depending on the kind of work that's being done. So as we think about that and we use different terminology, know that everyone is not going to understand the words that we think are easily understood to be the same. Next slide, please. So this last one is probably the one that I've spent the most time on. Notably, I'm not a confirmed author in any of these chapters, but I was involved in selecting the authors. We're talking about research and applied analytics from across the country in all 3 of these volumes. But this is the one that I've probably spent the most amount of my time on, around financial innovation. When you think about government investment, we've already talked about technology and skilling and credentialing, but this idea of what a regional workforce development system is and is not. And under the Workforce Innovation Opportunity Act, or WIOA, there is incentives for workforce systems to work together. So if you were a countywide workforce board or engaged in one, how much work can you do with the county next door? How much effort can you put into community colleges that may be broader than your individual strategy? So there is incentives under WIOA as well as the Community Reinvestment Act to think more regionally, to bring more individuals and topics to the table. Next slide, please. So here are the opportunities for investment, and I use this word very from a very targeted perspective, and financial institutions, your largest bank. So these are banks with above $326 million in assets, are going to be most interested in investing in programs that meet their CRA mandate. Now, your CRA mandate is not defined; it's not fixed. There are no metrics. The OCC, as we'll probably hear about from Barry tomorrow, has put out some new rules that is going to be more metric focused. The Federal Reserve has put out some information, an advance notice of proposed rulemaking that also talks about metrics. But when you think about this, banks are really looking for investment strategy. They are looking for a rate of return on their funds. Yes, they can donate money. And yes, they can loan out money, but they're looking to further their investment. And what can they do? So they can invest in core programs that directly connect workers to jobs. So this could be direct training, this could be career and technical education, this can be employer partnerships with community colleges. Financial institutions can subsidize enrollment fees or technology fees, or in this Project Lemonade example that I've been learning more about, thinking about providing low and moderate income populations or underprivileged youth those laptops that gets them more engaged. These are the kind of things that financial institutions are thinking about. Investing in intermediaries. Now, the intermediaries can be different things. This could be a mom and pop shop that does direct referrals. This could be job boards. This could be working with libraries to host a different workforce development meeting. So again, intermediaries are very open under the CRA. The CRA is a playbook. It is not a checklist. All right. So when you think about investing in early childhood education or community infrastructure, transportation, when you think about affordable housing, these are all things that banks think about, but banks are not in the business of developing their own strategy. Banks have to be in the business of funding and working with partners such as yourselves that are coming up with these ideas that they can use for their CRA program. Comprehensive support services, which gets to those wraparounds where it might be in dealing with domestic violence or dealing with addiction. But really the bottom ones are sort of the bread and butter. You're talking about entrepreneurship, you're talking about small businesses, you're talking about social enterprises. And different banks are going to have different strategies. All banks are not created equal. So one of Jason's pieces of advice is to think about the kind of bank you want to work with. Talking to a bank's president may not always be the best line of defense. That may not be the best offensive maneuver. You want to get with the CRA officer. You want to think about a bank CRA committee. You may want to think about a local branch manager. But all this has to be a result of conversations and relationships with your individual market. Next slide, please. So what is workforce development to CRA? We've talked about this. Federal law passed in 1977. This encourages banks to meet the credit needs of the communities that they're licensed to serve. Obviously, that includes low and moderate income communities. But one point that has not been made that I want to stress is that CRA only asks institutions to lend, invest, or serve with entities that they believe are safe and sound. All right, so financial institutions do not have to and will not be required to participate with any organization that they do not believe is fiscally responsible, has a strong reputation, that may not be serving within the community's best interest. There is no mandate that any institution, regardless of how good people think it operates, once you get into the numbers, financial institutions are not required to invest in entities or do deals that they do not believe are safe and sound. And regulators such as myself would be critical of those transactions if they had. So no matter how good the CRA impact might be, if it's a sinking ship or there's been cases of fraud or there hasn't been strong due diligence, banks are not going to be interested in investing in those groups, and rightfully so. So let's move forward to the next slide. Oh, I think we skipped one there, Bob. Yep. So linking workforce development to CRA. So this is where we're talking about that asterisk down at the bottom. This number does change January 1st of every year. For 2020, assets greater than 326 million and up to 3.05 billion. This is where you're going to get your large banks. Now above 1.305 billion is going to be all other institutions, and this is where a lot of the banks that Barry supervises is going to come into play. But it's really institutions with over 326 million that are going to be interested in working with organizations in New Hampshire and across the country around these categories. And I put down affordable housing. I realize this isn't a housing convening, but when you think about workforce housing, when you think about getting individuals closest to their employers of where they live with affordable rents or mortgage payments, that's very much part of workforce development. When you talk about revitalization or stabilization, what's happening right now in the COVID pandemic, this is all about revitalization. This is all about how entities are stabilizing employers and stabilizing communities and helping LMI people not only get jobs, but retain the jobs that they have. And you think about economic development and infrastructure, and then community services, which I'll spend a minute on in the next couple of slides. Next slide, please. So this is really the game changer when it comes to workforce development. And what's written here is very legalese or regulatory ease, but in July of 2016 is where workforce development was specifically added under the CRA questions and answers for CRA. Now, previously it was probably implied, but because of the feedback we received, we put in specific regulatory language. So you're talking about workforce development or job programs for LMI or unemployed persons. And then when you talk about investments in that second point, but I put loans, I put investments, I put services, all under the definition of these two questions and answers. Next slide, please. So how does linking workforce development and CRA come together? And I want to spend just a minute here on each of these bullets. And what we're talking about is direct funding via loan or investment in a public or private sector initiative. So what this means is that financial institutions can get CRA credit for working with a city or a town, a mayor's office, and a city planner in thinking about local economic development or partnering with other development strategies that city or town has around workforce development. So leveraging public sector money is eligible. But I really want to also stress private sector. We're hearing examples of employers working with individual banks to supplement their own training initiatives. So there might be a registration fee for getting to that next level or taking a course. Private sector employers can go to banks and say, hey, we want to work with you to help some of our employees with their registration fees to get them above that minimum wage or that next tier above X dollars per hour. Training incumbents is a big part of what workforce development and CRA can do across the country. Offering financial education, I think that goes without saying that financial literacy, regardless if 95% of people have an account, There isn't necessarily a metric out there that talks about what % of those individuals are financially literate. And even when you get college-age people in a room, or college-educated people in a room, and start talking about, you know, some complexities in dealing with their own retirement accounts, everyone can always use a little bit more financial education. So even though there isn't the CRA benefit per se, you still want to focus on low and moderate income populations. But really, that's such a bread and butter element for banks to participate in. Other things banks can get credit for under the CRA is just providing meeting space or other administrative support to entities working on workforce development. So if there's a local workforce development board meeting, if there's a job fair, if there's opportunities to mentor or coach or review resumes, interviewing skills, professional skills, career planning for at-risk youth or college students. Banks have to document this and understand what the impact is, but there are opportunities for banks to engage and get CRA credit that may not be dollars and cents. Time spent, CRA service hours can also be eligible for CRA. But I want to point out to you that there really needs to be some sort of financial acumen associated with their efforts. Now, as part of the CRA modernization effort, some of those standards may be changed, but really, if you focus on IT, or you focus on human resources, or you focus on the financial acumen, banks are going to have a good idea of how they need to document and what they're willing to engage in. But that last bullet I think is important, where banks really are charged with leveraging existing local, regional, national sector strategies. So banks are not expected to create something new in the workforce development space in order to get CRA credit. They are very much incented to be innovative on what's already there. So, you know, thinking about what's been happening recently, if there have been plant closures, if the Main Street has lost a lot of small businesses, if there's been changes in ag prices and in certain rural communities, how are banks helping those employees that may have lost jobs find new positions? So they really have to be reactive in some ways, but they don't have to create new things based on what's happening. If they're, it's all about planning. It's all about execution. So let's go to the next slide, please. All right. So what are the benefits? And this is one that I haven't heard many people talk about on the slides this week. So I want to be fairly candid on this slide. And what can we do to incentivize banks to participate? The first one is really improving the financial stability of their market. And when you think about individuals that are better employed, more strongly employed, they're going to have more money to put into the bank. And they're going to have more money to invest in other small businesses, or have second jobs, or just have more freedom and flexibility to buy a home versus rent. Banks are going to want to participate in this. This is the sell point. This is the strategy that says, all right, bank, if you work with me, I can help bring customers to your bank. I can help open X number of new checking accounts. I can help you in that new job fair. I can bring you entrepreneurs. That's really growing that talent pipeline in communities. Banks want to and are incented to expand their customer base. I think we would not be doing ourselves justice if we didn't recognize that banks are competitive. Whether there's one bank in town or there's 30 banks in town, banks are competing for a very finite amount of dollars. So what they can do to use CRA, and when I talk to bankers specifically, I talk about CRA as a competitive advantage. Being rated outstanding and the highest rating, yes, that's critically important to be able to showcase to your shareholders, to your staff, and being a good corporate citizen. But there are competitive advantages to working with more organizations outside of the typical list that banks would engage in. So this is where it gets back to strengthening the financial acumen of those communities and being partners with local chambers of commerce, with local development boards, with authorities, with the community college, understanding what those needs are, because banks can offer products, programs, and services oftentimes at their own discretion. Now, the bigger banks are going to have to go through more of a bureaucratic chain of command. But there are ways to put in special purpose credit programs, special grant programs, special partnerships that really help meet the need, especially in the COVID environment. Banks are not sitting on their hands. Banks do have money to lend. Banks do have money to invest, but they need to be strategic. They have to be open to new opportunities, but they have to be willing to hear about opportunities that are in the given market. And banks are very good at copying what other banks do. There is no such thing as having a copyright on an individual program. Yes, of course, the naming is often copyrighted, but the ideas of how to meet some of these needs, banks replicate each other's product programs and services often. Next slide. So how do we make workforce development more investable? And this isn't so much from a banker's view, but this is, again, what we're hearing through the Investing in America's Workforce Initiative, is classifying workers as assets, not expenses. Now, I think it's easier to say that than execute it, but we're often hearing that quality employers might be or employers might be losing staff because they're not willing to pay an extra $1 or $2 an hour because of the financial impact. But yes, that is the case, and that is very real math that needs to be done. But I'm often also hearing about examples where workers are being brought to the table that says, hey, if you're willing to pay me an extra $2, $5, $10 an hour, this is what I'm willing to do for you, which might be going out to getting a new credential or building a new skill. So thinking about workers as assets, I think, is often left off the table. When we think about maximizing existing funding streams, this goes back to leveraging Workforce Investment Opportunity Act dollars, WIOA dollars that workforce boards have from states and from federal resources to layer on top, along with financial institutions and other municipal programs, to build programmatic efforts that get to meet the need of communities. We like to see financial products increase capacity and scale, where we're looking for growth. Examiners are very much in the mindset, often in the mindset of what have you done for me lately, in that you may have gotten credit for CRA for doing a program, but that might have been 2 exams ago. Banks cannot rely on their laurels to meet every single need. I should also let you know that CRA is one of the few regulations that's public, that you can go out and actually find out how your bank, the bank that you're wanting to look at or partner with, you can find out exactly how they're doing on their CRA exams. Now, it's not going to list every single thing that they've gotten credit for, but it will show you the kind of things that they have gotten credit for. But CRA is also retroactive. So an exam that's completed in October of 2020 is going to look at how a bank performed in 2017, 2018, 2019. It's not an indicator of what they will do or how they will do in 2020, 2021, 2022. So you want to be thinking about banks as partners along the way, knowing that they may be willing to work with you, but not willing to work with you in 2020 because those allocations probably would have potentially been made in 2019. So banks often have 18 to 24 month rolling periods of the kind of strategies they're looking to fund. I just bring that out as something for this group to think about as you approach banks and trying to understand what their interest points are. Outcome-based funding models, which I think we've talked about in this conference, leveraging philanthropic capital. Every community does not have a strong philanthropic community, but there are national organizations that are looking at providing dollars to small businesses for growth, as well as linking to community colleges to further educational effort. If you don't have a financial intermediary, I often encourage groups to start one. If you know, there are models out there of very newly formed community development corporations or economic development corporations or even CDFIs that are started because there was a noted lack of those activities in a given community. But in order to do that, you have to get the right partners. You have to find a place to house it. But there are federal resources available, and a lot of consultants who will come out and help you build those. The Federal Reserve does not do that. But it's an idea that I bring forward as something that thought leaders may want to consider. And then measuring both short and long-term results, right? So we know that workforce development is a long-term run. A person placed in a well-paying job today may not pay benefits to that community for 6 to 12 months, but the idea is that you're hoping to build more momentum. Next slide, please. So let me just spend a couple minutes here on racial equity. We really see workforce development as a tool. as a tool that can help address racial and gender, and I put gender in this bucket as well, inequity. And what we've seen over time is there have been programmatic inconsistencies that have created occupational segregation that have steered women, minorities, opportunity youth to lower paying and possibly more unstable work. And some of this we need to be real with ourselves, of the history of this in our country, and also lift up those organizations, both private and public, that have said no more. But the idea is that workforce development and bettering our populations, CRA can be a part of this. CRA is still colorblind in the sense that it's not focused on race or gender or age. It's focused on that income level. But I think we need to be honest with ourselves that a lot of the low and moderate income communities that we see across this country are going to have higher percentages of minority composition than those that don't. But the idea is that we really want to make sure that we are working with individuals as a system to put them and place them in based on their strengths, not on how they look. But that can't be done without identifying partnerships and collaborations that achieve a vision of commitment to racial equity. And again, traveling across the country and looking at these, you're not going to see any community that opposes this. You're not going to see as much aggressive redlining that you saw years ago. But we also have to be honest with ourselves that there are still models out there that are promoting poor behavior and promoting these inconsistencies that need to be addressed. Next slide, please. So how can racial equity also play in this? And workforce development programs consider job quality measures. So thinking about output as well as outcomes. And this is where you might need an advisory board, or even a board, an advisory board of people who do this work that can come up with their own measures of success. I think about this in the manufacturing front, not just about the number of X widgets produced per shift or whatnot, but the quality of that product and the amount of oversight that it takes to meet objectives. Workforce development can be a part of that, but I think the voice coming from the people is often a leading measure of success. And then we talk about internal pathways and benefits. That's come out quite a bit during this conference and in the various sessions. So I was very happy to see more conversation around pathways. And this idea of collaborative investments, and this goes back to the layering, right? So the idea of how organizations can work together to layer their financing, layer their networks, layer their commitment to this as they go forward. Next slide, please. So what are some promising strategies? And this is really from Jason's views and Jason's views only, but the idea of better alignment of workforce and economic development efforts using sector strategies and leveraging those intermediaries to broker those relationships. So when we think about communities that might be very strong in education, or those communities that are very strong in the medical field, or when you think about manufacturing operations, or you're thinking about different clusters of employers, when you think about transportation, there's communities know what they're good at. They also know very candidly what they are not good at and where they need assistance. A financial institution may not be in the best position to talk about what's needed in the market, but they are in a good position to understand how they fund employers or fund businesses or farming operations that work, and the kind of strategies that those individuals use to further their own mission. We've talked a lot about apprenticeships and earning and learning, and I don't think I need to talk to this crowd about the importance of that, but the idea of getting people at an early age, or even mid-career or late career, into something new where they can get paid, they have access to affordable childcare, getting in so they can sample what life is like on the ground. And I would encourage this group to think about not just blue collar roles. This is not just about apprenticeships in welding or metal fabrication. You're talking about apprenticeships in bank telling. You're talking about apprenticeships in IT. You're talking about apprenticeships in insurance underwriting. You're talking about apprenticeships in logistics. You're talking about apprenticeships in transportation. So there can be different blue collar, white collar, or no collar that gets employers to think about bringing in that next generation of employee. I already talked about this next bullet, but I want to stress enough that in our surveys and thinking about employers, training for incumbent workers is really needed. Yes, it's often easy to bring in somebody new or someone at a cheaper wage. And yes, that has benefits, but I often stress that the idea of working with incumbents of yes, I do the role, but this is what I need to do my job better, or this is what I would like to be in 18 to 24 months, and having a culture of providing access to those individuals. I think this is where the pathway discussion and those incumbents really comes together with positive results. Increased coordination with funders. This gets back to thinking about strategies for a given market. I always like the idea of developing a problem statement with an executable plan that goes forward of how to get somewhere and what kind of funding is needed to be able to move that needle. And then lastly, changes in employee behavior that improve job access and quality while contributing to performance. So every dollar spent may not yield the exact dollar plus in return to that business, but the idea is that if you're improving morale, you're improving access, you're improving longevity, that this may be a good strategy. So next slide, please. So what have we talked about today? And I want to leave some time here for dialogue. The workforce development landscape is responding to the pandemic, but it's evolving. In the digital world, we are still consuming goods. We are still thinking about ways of doing our work efficiently and effectively. But there's still work to be done. We do not have to wait for the vaccine and even post-vaccine to be able to think about how work is done, and work is done efficiently and effectively. There are opportunities, and let me stress, there are opportunities for banks to engage in workforce development efforts in both urban and rural markets. Their CRA does not include a finite number. Okay, there is not. I don't like the term CRA dollars. All right, I like the term CRA investment. Because banks have to decide what meets their objective. But again, CRA being a playbook, they can decide how they meet that objective. Some banks are going to be very active in loans. Some banks will be very active in donations. The idea is that there isn't a one size fits all. So I encourage you to try to find those partners that align with the mission that you're trying, or the objective that you're trying to put forward. But banks and civic as well as agency leaders may need coaching about how to engage with local workforce development. I think that, again, CRA being included, or workforce development being included in CRA is only 4 years old officially. Now, again, there was some conversation about this for decades, but officially, you're talking about only since July of 2016. But CRA is being modernized, and there is an opportunity right now for anyone on this call to comment on the Federal Reserve's proposed rule about the kind. Now, there are 99 questions that we're asking entities to respond to. You do not need to do that. But the idea is that if you do have ideas of how CRA can be more effective in your community, we definitely want to hear from you on that. I did put in a couple of hot links, which I know Bob can send out. There is a periodical, or a publication that the Fed of Kansas City and Denver put out. Dallas and Kansas City put out a couple of years ago, called Engaging Workforce Development, a Framework for Meeting CRA Obligations. A lot of the information that I put forward here today is pulled from that publication. It is downloadable for free. We're in the process of thinking about updating that in 2021. So if you do have ideas of how to improve that document, but there are case studies in that document of organizations that have done this, that have leveraged CRA dollars to meet a workforce development objective. The second bullet is the Center for Workforce and Economic Opportunity. This is out of the Federal Reserve Bank of Atlanta. This is the organization, the Fed, that published those books. If you click on that link, you'll be able to find everything that the center is working on, but also find copies of those books or specific articles that you'd like to learn more. And then lastly, community development offices, such as the one that I sit in Chicago, are resources. We can come, and whether it's me or someone from the Northeast that can come and lead a workshop, we are very good moderators. We can provide data. We can walk you through workshops of different entities. And that's really how I found Bob in the first place. Was he had gotten wind of one of these workshops that I had done and had reached out. So our services are free. We can't even charge you for our travel once we're able to get back out there. Let me just move on to the next slide, which is the appendix. And there's a couple of slides on this, and I'm not going to go through this. But essentially, these are some discussion questions that I have found work very well in small groups. And as you sit down with local workforce development practitioners or community colleges, or if you're meeting with chambers of commerce, possibly thinking about, Bob, if you then move to the next slide, there is 6 of these questions that I put forward that essentially you could use really any way you like, but I think that I've seen them in action, and I've seen report outs that come through that really get, depending on the diversity of the people working on them, have really been effective in trying to understand what a sector strength is, what partners need to be at the table, and what are those opportunities that leverage what's already happening to give everyone a better chance at stronger workforce development for a community or a region. So I put these questions out to use at your will, but I'd also be interested in finding out if anyone who does use them, how that may have worked out in that particular session. And then the last slide, Bob, is my contact information. I have no problem with you reaching out to me directly. I'm most available now via email. But this gives my cell phone number and my office number, which I often check. So hopefully I've met the objective of what you all were interested in hearing. I think we have about 10 minutes or so for questions or comments, and I'm happy to engage.
Jason, this is Bob again. Thank you so much. What a fabulous orientation to CRA and workforce development. This is tremendously timely for all of us on this call. And for those who couldn't join us, we're going to make sure they get the recording link, Jason. While folks are thinking about questions they might want to put in the chat here, just to lead things off, I'm wondering what your thoughts are about can you and your colleagues with the Federal Reserve System and perhaps also FDIC and OCC, might you all be able to help us as we design collaborative approaches to CRA and other joint investments in economic inclusion? Are the ways in which you could help us design systems that would capture formatively and summatively impacts? Because one of the things that you've said recurringly throughout your very helpful presentation was the value of being able to track impacts so that funders know they're getting good bang for the buck and we're watching the dials that matter move. Is that something you all can provide some technical expertise to help us with?
Absolutely. Well, I can't speak for my OCC or FDIC colleagues, but I'm very good in sitting on advisory committees and working through group initiatives, and thinking about ways that banks can engage. And any feedback I provide obviously has the disclaimer that it's really that of my own. But I've done this in the past where I've worked with individual communities, really smaller urban markets, to think about their strategy. And they include me in their monthly or quarterly calls and just to listen to what they're talking about. But impact itself isn't always about a number, isn't always about the number of jobs created or the number of placements through an apprenticeship program. I've often been troubled when you think about impact, where you'll say, okay, well, we did this program and we had 20 graduates. And 20 graduates is a good number. At least one would think it's a good number. But if the need is for 100 graduates, why was there only 20? Then I think about, in that same vein, where someone will say, yes, we had 20 graduates as part of a program. And then I'll say, okay, well, that was in granted 2020 is a COVID year, but say that was in 2017 and I was talking to this person in 2019, I would say, well, what is the tracking of those 20 graduates 2 years later? Are they still working at the placed entity? Have they moved on? Has their wage increased? Have they developed new skill sets? Programmatic efforts are not designed to track over time. And I've often thought in my next lifetime, I would build something that would help entities track over time, that would help financial institutions talk about their impact. Because remember, impact on CRA is retroactive. So a bank is going to say, yes, we funded this in 2017, but they're not going to know unless someone tells them what actually happened with those dollars. So any effort that a group would put together, I would say keeping that bank engaged after those monies were given would really help their cause in talking to their examiners. I will tell you that CRA is storytelling. It's not creative writing. You're not supposed to fabricate what didn't happen. You're supposed to have a stronger story on what did happen.
So Jason, we have a very helpful question from Lori Langlois with North Country Educational Services, I believe. And she's asking, is there a way to determine ballpark-ishly the rough amount that a bank might be expected to make is obliged to make under CRA.
And the short answer of that is today, no. But as I said, the OCC is thinking about more standardized metrics to help the public understand, how a bank is meeting their objective. And the Federal Reserve, again, put out an advance notice of proposed rulemaking, also thinking about this very strategy. But a very easy workaround on this is to download a bank's performance evaluation, which can be found for free at www.ffiec.gov, ffiec.gov. You can download any bank's performance evaluation and find out what they did get credit for, and essentially back into where you think that bank might try to meet the same obligations going forward. But there is no set amount of what a bank has to do. But I have not found a bank that is not willing to talk about a new strategy or a new line of business or a new partnership. Again, it may not be during this exam period, but keeping that dialogue open. I should also say that credit unions are exempt from CRA. Credit unions do not have to comply with CRA, but there are still plenty of community development credit unions and other entities that may still want to partner, but know that they are not required to make the same loan investments or services. And then before we get to the next question, I will also say that CRA is really in the effectiveness or impact is really in the eye of the beholder. And as we think about these strategies, banks are rewarded for being innovative. Banks are incented to be part of complex transactions, and banks are incented to use their financial acumen. But other than that, CRA can really be a lot of different things to different people.
So Jason, there's another question that Lori asked about: can a CRA investment be targeted to support a workforce development project of a nonprofit, or do the funds have to go to municipalities? And my understanding is indeed that there's quite a bit of flexibility in terms of how these resources can go.
Absolutely, and nonprofits are very much eligible, but you want to be mindful that the bank is going to have to document how at least 51% of that nonprofit's efforts are meeting the needs of low and moderate income populations. So you want to kind of keep that 51% rule in mind as you think about this. Now, there are some, again, the OCC and the Fed are thinking about possibly changing this as we go forward. But as of right now, you want to kind of think about documenting if your nonprofit's efforts address that 51% rule, the bank would get credit for their full 100% investment.
And Jason, if I could pivot to something that the consortium of a dozen banking leaders that have operations in Manchester, New Hampshire, have undertaken together, that I think speaks pretty excitingly to your notion that about looking at not only quantitative impacts in terms of number of jobs created, but also qualitative. So this group has identified two, what the group has called low-hanging fruit. They're looking to make long-term impact on poverty in Manchester for LMI kids and their families, right? And so they're looking at some short-term ways just to get started and be methodical and incremental, but two short-term ways of getting going, so the group can build experience working together and momentum and track record and that sort of thing. One is Operation Lemonade, as you mentioned, which is co-financing devices to help LMI kids get on the other side of the digital divide. But the other is very pertinent to your comment of a moment ago, which is around inclusive pathways into living wage careers, starting with two. One initially, pathways into banking, and then secondly, pathways into teaching to diversify these workforces. And what the group has identified as a long-term impact is that they're hoping not only to make these workforces more diverse, the banking workforce and the teaching workforce, but we also believe, and there's some empirical basis for this, particularly around diversifying the teaching workforce, we also believe this is going to have intergenerational benefits. So for example, in teaching, there's a lot of research that shows the diversity of the teaching workforce contributes significantly in very positive ways to attendance of kids of color, narrowing the achievement gap, improving graduation rates, lowering the disproportionate representation of kids of color in discipline and special ed, a variety of really important impacts. And we believe that diversifying the banking workforce is going to have a very similar kind of long-term qualitative benefit, and quantitative too, perhaps, in terms of improving the cultural capital and competence that banking employees bring to their work with communities of color. Does that make sense?
Absolutely. And I will also say that another proxy for working with schools, K through 12, is the percentage of students under free or reduced lunch. And the kind of efforts that banks are going to want to do with K through 12 kids is going to be different than what they may want to engage with community colleges. But data is really your friend in working with financial institutions. But in a school district like Chicago, that's actually not as helpful because the entire district is on free or reduced lunch. But in other places that still sort of break that out, that could be another proxy for documenting how a financial institution might be engaged from a CRA perspective.
This is fabulous, Jason. One last wild question for you. Do you think are there ways in which let me say it this way? I'll own this perception. My perception of the CRA ecosystem is that there's an enormous amount of wonderful, brilliant, impactful, innovative stuff being done to support addressing poverty, but that there's not a great systematic approach to harvesting promising and proven practices. And wondering what your thoughts might be on ways in which we can improve on that, make it easier for banking leaders and their partners to find out about really wonderful things that individual banks have done.
Yeah, and I think you are correct. There is not anything right now that you can sort of download that says, yes, this is what was given CRA credit and what the impact score might have been, or thinking about impact. And the regulators are working right now to make that more transparent and more digestible nationally. But I will say that publication that I put forward that was out of the Dallas and Kansas City Feds, and you commented on the work that the Dallas Fed has also done on digital inclusion. Those sort of working documents that the Fed thinks about really tries to put forward a few case studies on things that were impactful, but by no means is that an endorsement of those organizations. It's a description. But people like me who speak 30 or 40 times a year at conferences are really charged with putting forward ideas like this that can be replicable or brought to scale elsewhere. As an example, March of 2020, we were supposed to be in Denver, Colorado. There is a National Interagency Community Reinvestment Conference, or NICRIC. NICRIC is held every other year. It was supposed to be in Denver, obviously postponed because of the virus. We are now scheduled to be in Portland in March of 2022 to have this, but that is really the national premier event for everyone to come to hear about innovative strategies. Walters Kluwer also puts forward a fair lending and CRA colloquium. This year they've been doing, instead of, it was supposed to be in Vegas in October or November, but they're doing a series of one-day exercises. Anyway, the point of that is another organization that brings CRA practitioners together nationally to talk about innovative practices. So face-to-face or virtual communication right now is probably the best way, but the regulators are thinking about putting out more information in a digitized environment to help people like you understand impact.
Well, thank you, Jason. And having attended the last interagency conference in Miami a couple of years ago, I can certainly attest it's an amazing experience to get examiners, banking leaders, regulators, community partners, all in the same room in real time saying, do you like this idea? Yeah, you like it, you like it. And it's a way of growing consensus about innovation.
And one thing I can say in closing, Bob, is that if anyone on this call would like to just float an idea past me or say, hey, this is what we're thinking, what kind of questions should we be talking to our bank about? I am happy to do that. Again, I can't guarantee CRA credit, and we do not make direct connections to banks that might be interested in your sort of proposal. But I have done what we call technical assistance, where I will look at a project, program, or service and provide you the kind of questions that a banker may ask.
This is fabulous, Jason. One of the things I'll circle around with you afterwards as your time permits, Jason, is to with your kind help to get the link to, you mentioned about the comment, the public comment, the request for comment on the proposed new rule for the Fed on CRA. I'll make sure we get that out, and I'll make sure we get the links out to those 3 wonderful volumes that you shared about investing in workforce development. So we'll get those out along with your great slideshow and this recording out to all summit participants. And I'll make sure that you have those links as well, Jason. And I just want to thank you on behalf of everybody here for a very informative and important conversation. Thank you so much.
Thank you.